A pro-crypto president got elected and we thought we had tickets to Valhalla. Instead, we got
tariffs, tremendous tariffs that are massive. To me, the most beautiful word in the dictionary is tariff.
Trump has ordered
tariffs, turbulence, and a market-wide bloodbath. But is this cycle cooked, or is there light at the end of the tunnel? What's on the horizon for 2025 and beyond? Is it time to buy, hold, or brace for more pain? We're unpacking the massive macro forces shaping Bitcoin's story right now. Trump's tariffs, inflation, the QT pause, rate cuts, and the global M2 money supply. If you're curious where this market's headed, stick around. This video is packed with insights you won't want to miss. We'll also take a trip down memory lane to revisit the monetary policy during the face-melting alt seasons of 2017 and 2021. We're diving into the data that reveals whether you're holding a ticket to Valhalla or a bag of regrets. If that sounds good, hit like to support the channel and subscribe if you haven't already. Massive shout out to everyone who voted for this topic on YouTube and Twitter. You're why we dig this deep. Alright, let's take a quick look at the market. Bitcoin is currently hovering around $84,000, stuck in a clear downtrend since February 4th. Price continues to face rejection at the daily EMA 21, which remains a key resistance level. Until Bitcoin reclaims it, I'd avoid high-risk altcoin plays. The breakdown of the $90,000 range low, followed by a bearish retest, triggered further downside. On the daily time frame, the market structure remains bearish. However, the monthly chart is still intact as long as Bitcoin holds above $65,000. The yellow box marks the maximum pain zone, a key level aligning with a retest of the previous all-time high. If you're looking to take risks on altcoins, wait for a clear trend reversal. Ideally, Bitcoin should reclaim the daily EMA 21 and move back above $90,000 before considering high-risk bets. For spot accumulation, DCAing into Bitcoin within the yellow box is a solid strategy, with a clean invalidation below it. However, I wouldn't recommend DCAing into altcoins yet. Anything near the yellow box presents a strong discount for Bitcoin. Meanwhile, Bitcoin dominance remains firm at 61%, while the altseason index has dropped to 31, signaling continued strength in Bitcoin over alts. This cycle is clearly stretching out and the current dip just backs that up. The bull market isn't done yet, but for Bitcoin to make its next big move, it needs the macro environment to play along. The right monetary policy could be the spark it needs. No more waiting. Let's jump into the macro setup and see how things are shaping up. Trench warriors are on high alert as the Federal Reserve gears up for its March 19th meeting. They face a tough setup, a market sell-off, weak economic data, and a growing trade war. While rates are almost definitely staying put this month, all eyes will be on Jerome Powell's press conference. His response to Trump's newly proposed tariffs and the overall stance he sets for financial markets will be closely scrutinized. Recent economic indicators have added new layers of uncertainty. Consumer sentiment is deteriorating, retail sales have slowed, and the labor market is now showing early signs of weakness. Jobless claims have started ticking higher, and layoff announcements are becoming more frequent, particularly in the tech and finance sectors. Inflation, measured by the Fed's preferred core PCE index, remains at 2.6%, still above the central bank's 2% target. Rising tariffs could reignite inflationary pressures, putting the Fed in an even tougher position as it tries to balance economic stability with inflation control. While not officially confirmed, market expectations and recent Federal Reserve minutes suggest that the process of quantitative tightening, which has been actively reducing the central bank's balance sheet, may come to an end by March 2025. In its January meeting minutes, the Fed stated that various officials believe it might be necessary to pause or slow the ongoing balance sheet runoff until the Treasury debt ceiling is resolved. This resolution is expected around July or August. If that happens, a liquidity drain from the U.S. banking system could follow, potentially transforming a temporary pause in QT this March into a full stop by summer. One of the biggest concerns is the potential impact of quantitative tightening on the banking system. The Fed has already been reducing its balance sheet by letting bonds mature without reinvesting the proceeds, which effectively pulls liquidity out of the financial system. While banks have so far managed to adjust, history shows that excessive liquidity tightening can lead to instability. The first major instance was in 2019, when an unexpected liquidity crunch in the overnight lending market, known as the repo market crisis, forced the Fed to step in with emergency cash injections. The second came in early 2023, when rapid rate hikes and QT contributed to bank failures, including Silicon Valley Bank. Now, with a possible resolution of the debt ceiling expected later this year, liquidity conditions could tighten even further, raising concerns about whether banks will be able to handle it. A third liquidity crunch could undermine the Fed's credibility and force it to reverse course. Recent data shows that discount window lending, which allows banks to borrow directly from the Fed, has been rising steadily since early November 2024. While the current borrowing level is still relatively low at around $3 billion, the upward trend suggests that some banks are already feeling the strain of tighter liquidity. Powell's press conference will be critical in shaping market sentiment, especially for the S&P 500 and broader risk assets, including cryptocurrencies. Right now, the S&P 500 is trading below its 200-day simple moving average. The index is struggling to hold above $572, and if it fails to break this level, further downside to $540 remains likely. On the other hand, a strong rebound from this level could reignite bullish momentum and trigger a recovery across equities. Beyond equities, the Federal Reserve's policies have historically played a significant role in shaping the trajectory of Bitcoin and the broader crypto market. Bitcoin's biggest bull runs have coincided with periods of loose monetary policy, particularly when the Fed was expanding its balance sheet through quantitative easing. In 2017, Bitcoin surged from around $1,000 to nearly $20,000. One of the main reasons behind this rally was the years of liquidity injection that followed the 2008 financial crisis. The Federal Reserve had kept interest rates near zero for almost a decade and had engaged in multiple rounds of quantitative easing, dramatically increasing the amount of money circulating in the economy. While the Fed did start hiking rates in 2015, its balance sheet remained historically large, ensuring that there was still plenty of liquidity in the system. As a result, risk assets thrived. Retail investors poured into Bitcoin, Ethereum, and a wave of ICOs, driving a massive speculative boom. However, the rally came to an abrupt end when the Fed started quantitative tightening in late 2017. By 2018, the financial conditions tightened significantly, and Bitcoin collapsed by more than 80% from its peak. Fast forward to 2020, and the pattern repeated itself in an even bigger way. When the COVID-19 pandemic hit, the Federal Reserve responded by unleashing unprecedented levels of monetary stimulus. Interest rates were slashed to zero, and the Fed injected trillions of dollars into the economy through a massive quantitative easing program. The flood of liquidity sent asset prices soaring, and Bitcoin was no exception. It surged from $3,000 in March 2020 to an all-time high of $69,000 by November 2021. The bull run was fueled not just by retail investors but also by institutional players who saw Bitcoin as a hedge against inflation and currency debasement. However, just as in the previous cycle, the rally came to an end when the Federal Reserve reversed course. As inflation surged to multi-decade highs, the Fed began aggressively hiking interest rates and resumed quantitative tightening in 2022. With liquidity drying up, Bitcoin and the entire crypto market entered a deep bear market. By the end of 2022, Bitcoin had dropped more than 75% from its peak, mirroring the collapse seen in 2018. The pattern is clear. When the Federal Reserve loosens monetary policy, Bitcoin flourishes. When the Fed tightens, Bitcoin suffers. As the market anticipates an eventual pivot by the Federal Reserve, the key question is whether another liquidity-driven bull run is on the horizon. With rate cuts expected later in 2025 and QT likely ending by summer, market dynamics could shift significantly. If liquidity conditions improve, the crypto market may recover further from its recent slump. The Federal Reserve's next moves will be critical. Whether we're on the verge of another major rally or facing renewed volatility will depend largely on how monetary policy unfolds in the coming months. For now, it appears the worst may be behind us and the bull run is far from over. There could be some more short-term pain with a potential test of the $73,000 level. However, Q3 and Q4 look promising, given the macro landscape. Hopefully, the money printers will soon go. That's it for today. See you in the next one.